Hello and welcome to Analyzing Finance with Nick. In today's video, I'm going to be talking about crisis investing. When does it make sense to bet on the world ending versus betting on the crisis improving itself naturally? And what signs are we aware of whether to put the pedal on the gas or put the pedal on the brake when it comes to future volatility and distress in the markets? This doesn't just apply to geopolitical crises such as what's going on in Ukraine right now, but it also applies to economic crises, domestic political crises, and social crises that also are affecting the market. There are several variables that I look at for whether it makes sense to bet on the crisis getting worse or to take off those positions. First I want to look at is, what is the market's view on it? Is our volatility, implied volatility on the most affected assets elevated due to these fears? Is the price action been intensely negative in these fears that basically investors are starting to realize what's going on, and are they just dumping? And how aggressive are they with trading? Is there a lot of intraday volatility? Are the order sell orders getting sloppy? These are things that I would look at. Like an example I'm going to use is since I did this in my last video, the Greek debt crisis. I'm not going to talk about Ukraine specifically on this video just because I save my commentary on that for my clients, but this will be a good analogy to look at for future crises you may run into in your investing careers. So back in 2014, it was well known that Greece was still in financial trouble. There was risk of a radical party called Syriza getting elected and threatening to break the previous deals that the Greek governments have made with the Troika. But some of the most affected assets from this, such as the stock of Deutsche Bank and some of the other big European banks that had a lot of exposure to peripheral sovereign debt, had low implied volatilities as if it's just a normal day in the marketplace, and were trading at relatively high prices versus where they would have if there was a real panic. And in that scenario, like in late 2014, Q1 2015, even just when Syriza first got elected, there was an opportunity to bet on higher odds of a crisis happening that seemed to be evident that the market was being discounting of. You're at the phase when investors or markets are like, oh, that risk is there, but is it really going to happen? That's kind of the time you want to put on those bets. So an example then would be Q4 2014 for putting on sovereign debt, anti-Greek sovereign debt type trades in the equity market or derivative options market. Where on the other hand, once the negotiations were in full swing and you had Varoufakis resigning and people threatening to cut off their ATM machines on both parties, and mass civil strife and people protesting on the streets, and implied vols through the roof, that's the point where you don't want to bet on the crisis anymore. And general rule on crisis investing is that unless if it truly is the end of the world, it's unlikely to trigger a bear market greater than, say, 15 to 20%. If it's just on that crisis alone in the S&P 500, it could be bigger in other countries that have more volatile markets. And in general, the only time really you've had drawdowns bigger than 50% was during the Great Depression. And if you have a bear market of a larger than a 20% drop, it has to be tied to some fundamental earnings decline. or a more structural cause beyond just the news story that's causing the panic. Like, for example, with the Great Recession and the financial crisis, that had a material negative impact on earnings because of a lot of lost income from banks having to write off their properties and people losing their homes, and less spending, and therefore less jobs. It compounded into the economy. Whereas if you look at many of these geopolitical crises, for example, or an invasion of a country that's not tied to the global supply chain, yeah, it scares people. But once people realize it's not World War III, then cooler heads prevail. And so if you're going to make a bet, a tail bet on the market that's greater than a typical bear market range, then you have to have a pretty good conviction that either one, it's going to lead to a dragged out recession, or two, that basically you're going to have a decent probability of the whole economic system collapsing. And if you are right about number two, that's the other problem with betting on the apocalypse, as I like to call it. There may not be a counterparty to pay you. So, say for example, like with 2020, during the peak of the COVID panic, you had markets down over 30% and falling at record pace per day on a lot of these days. It was crazy. It's quite scary, to be honest with you. But let's just say if the pandemic was far worse than it actually was, and it did lead to the point of complete shutdown of the financial system, and you were short S&P futures and rode them down to, like, I don't know, 500 on the S&P, like a 90% drawdown or more, then what would there be? Like, if all the banks are bust because of this, and all the brokers or dealers or exchanges are all in financial hot water, who's going to pay you on that trade if you're right? I mean, this even happened with the Greek debt crisis, when ISDA took a long time to rule on as a default, and a lot of the people who bought those swaps had to go through years of litigation to get paid, and not even completely paid. So, same with Argentina's debt crisis too. So if you're going to bet on the complete collapse, you need to make sure that either one, there's going to be a counterparty left to pay you, or two, that if there is a counterparty left to pay, you have the resources to fight if they try not to. That's one reason why I've kind of stopped betting on the apocalypse. The other thing is if really things are that bad that the global financial markets are down 70+%, it may not be physically safe for you to even be able to make those claims. It'd probably be a war zone in your country, and you may have to have a lot of other things to worry about, such as your own survival, over whether you're going to get paid on your put options. I think with single stocks, that's a different story, because a bad company can fail no matter how good the economy is. I think even with volatile assets such as commodities and cryptocurrencies, you can see those types of drawdowns. And in certain countries that have more volatile political systems and economies in the emerging world, yeah, you can see those type of drawdowns. Like Cyprus, for example, had a 95% plus drawdown in its stock market. But Cyprus was such a small country in the financial sense of the word, there really wasn't a derivatives market to short a Cypriot exchange, whether it's futures or an ETF or put options. So yeah, that makes those tricky. So the thing is that you have to think beyond a certain point of downside on a broad macro index trade. You have to watch out that you're not just implicitly betting on the end of the world without knowing it. And also, that's the same thing when you buy volatility when VIX is above 50. Yeah, it could work sometimes. Like, it actually did work for about 2 weeks in March 2020. But generally, that's a losing bet. Buying vol when VIX is above 50 and buying protection at that level is basically implying that you're betting on the world to end. And it's not a smart trade for the reasons why I mentioned it. So in general, if you're going to bet on a crisis, it's one, you want to bet on it when it's obvious that the risk is real and coming, but the market doesn't seem to acknowledge it. And you know what? These type of tail bets, they tend to work less than 50% of the time. But when the chance becomes from a slim chance to a reasonable chance, say like odds of something bad outcome happening goes from less than 5 to say 20 to 25, and those probabilities are a subjective analysis. I mean, the super forecasters do their best to try to analyze this stuff, and they actually got the whole Ukraine thing right. And I'll send a link to their publication. Then you can do it that way. That's when it takes sense to bet on a crisis, is when it becomes like goes from a tail fantasy scenario to somewhat reasonable. Just make sure your payout is high enough that if you're wrong 4 out of 5 times, you'll still make money making those kind of bets. And throughout my career, I have made those kind of bets in the past, and you just have to structure the risk reward right to do so, and or have like some of your portfolio that's in stuff that will do well if this is a non-event. And then the other side of crisis investing is often the best times actually to be a buyer of assets. Usually when the event that everybody fears happens is usually when the market flips, whether it's called the buy the rumor, sell the news phenomenon. And this has happened countless times in financial markets through various means. Like, example, I remember my first one really in my career was when the S&P downgraded the S&P, the U.S. government's credit rating from AAA to AA plus, and that marked the bottom of the September 2011 panic around the Greek debt crisis and just the general people concerned about sovereign credit ratings. And then on the other side is when you have really good news that people have been anticipating for a long time, and then when it finally happens, it often marks a turnaround. But for both of these, the key is a long expected catalyst. Like, if it's something that just wasn't really expected by enough of the market, then momentum can keep going on its own. Like, a good example of this was when the vaccines came out in November 2020. A lot of the trades, such as in-person consumer services companies, and energy and other sectors that were more tied to the physical economy, still had a great run for months after the vaccine news came out, because there was a large chunk of the market that was not expecting that outcome, and that date wasn't really well telegraphed when it was released in early November of that year. And so you had a little bit of a run. However, if it's something that's more telegraphed and more well anticipated, like a Fed day or an election or some other like fear-inducing catalyst with a hard date, then that's more likely to have a turnaround. So that's my early thoughts on crisis investing. Let me know if you have any questions. The general conclusion though is, do not bet on the apocalypse unless if you have super good conviction on one, that you're right, and two, you'll have a reliable counterparty to pay out if you're right, and the risk reward is high enough that you get paid if you're wrong 4 out of 5 times. Thank you for watching.